Today, we are grateful to have the Deputy Governor of Bank Negara Malaysia to grace us with her presence. Please welcome Madam Jessica Chu.
Thank you very much. I hope you can hear me.
Yes, we can hear you.
Thank you. Distinguished guests, ladies and gentlemen, it is my great pleasure to speak at this year's Professional and Ethics Forum. I would like to thank the Malaysian Financial Planning Council for this opportunity to share some thoughts. I would also like to commend MFPC for making this forum a regular and key feature of its annual program. The subject of professionalism and ethics has long been an important one in the world of financial services, although of course it is not unique to financial services. Once almost taken for granted, today, considerable resources and effort are spent by authorities and firms alike to expound standards of professional and ethical conduct, draw bright lines, monitor and check practices, and hold individuals accountable. This may not always mean that professional and ethical standards have fundamentally degraded, but there are areas where trust deficits exist. Sometimes this is the result of irresponsible or reckless acts by firms or individuals. Sometimes they have to do with incentives that can cloud judgments. And sometimes trust issues can be linked to expectation gaps and an inadequate grasp of how economic, financial, and social developments affect society. Any effort to promote and safeguard public interest must address all of these dimensions. In the wake of the COVID-19 health and economic challenges, which are still with us, it is therefore appropriate for the industry to reflect and affirm its professional and ethical responsibilities to the public. And this would certainly be one of those times when those responsibilities are great indeed, as businesses and households across the country look to rebuild that which was lost and prepare to face a much different and uncertain future. For many, the road to recovery will not be easy. The financial shocks caused by extended lockdowns or loss of breadwinners who succumbed to COVID-19 have been most severe for lower income households and small businesses. Despite the swift measures taken by the financial industry to provide cash flow relief, they have had to draw down on already low levels of available savings, borrow more, and even deplete their retirement funds in order to make ends meet. Pre-pandemic, many households were already living with high leverage and insufficient for emergencies and retirement. Post-pandemic, these vulnerabilities are likely to have deepened. Recent reports of over 3 million individual contributors having less than 1,000 ringgit left in their EPF accounts, with only 3% of contributors having adequate funds left to sustain them through retirement, are an indication of this, and they are deeply concerning. The low levels of insurance and takaful coverage have also added to the financial stress of households already facing extended disruptions to income. These developments will further widen the socio-economic gaps between higher and lower income households, with longer-term implications for economic and social progress. This has also been a period in which the acceptance and use of online platforms has exploded. Driven by necessity and safety concerns, most households and business owners are now more willing and able to use digital platforms to shop for products and services, including financial solutions. This is likely to improve access, but at the possible risk of poorer consumer outcomes if consumers are more encouraged to act impulsively or due to a lower level of engagement before they decide to purchase a financial product. Attitudes towards environmental, social, and governance considerations are also rapidly changing, with important implications for business practices and investing decisions. At the same time, the current low interest rate environment could see more consumers take higher risks to boost returns on their hard-earned savings and provide for their future. Added to this, the relatively low level of financial literacy is likely to expose average consumers to higher risks from more complex insurance and investment products which they may not fully understand. Professional financial advice needs to be viewed in the period ahead. To make critical decisions on retirement planning, managing debt, providing greater security to their families, deciding on how to make their money go further, and have a positive impact on sustainable goals, and just navigating the myriad of digital financial options at their fingertips. Not everyone will seek professional financial advice, but for those who do, they should have confidence that they are dealing with someone who has their interests at heart, and they are receiving suitable advice and recommendations that take into account their financial needs and circumstances. There are good reasons to be confident. This industry has made important strides to continuously strengthen the knowledge and skills of financial advisors and planners. Most FA representatives have not only consistently met the requirements for CPD, they have exceeded them. Indeed, a significant majority of FA representatives bring with them long industry experience and deep knowledge of financial products. And there is clear evidence to support better consumer outcomes from unbiased and needs-based advice provided by financial advisors relative to other intermediaries when recommending insurance and investment products. This can be seen from the consistently higher persistency rates on insurance policies sold by financial advisors compared to other intermediary channels. Some financial advisors and planners have also gone the extra mile on social media during this challenging period to counter misinformation, educate, and steer consumers away from misguided financial decisions. The launch of the Investor Protection Group just yesterday is another example of proactive measures that this industry has taken to protect financial consumers. However, in a world that is rapidly changing and increasingly uncertain, the financial advisory industry will need to dig deeper to help your clients navigate difficult life and financial choices with confidence. Allow me to elaborate. First, the notion of suitable advice will need to be based on a deep appreciation of the life-changing experience that many of your clients may be facing. In the current environment, their financial circumstances are likely to be more closely interlinked with developments and dynamics in their family situations, their social experiences, their mental and physical health, their own confidence in their future at the workplace. Issues one will not find on typical customer fact-find forms. Second, financial advisors and planners will need to consider how your engagements with clients will need to change so that you can remain responsive to your clients' needs. How to engage, when to engage, and what to communicate. These are simple questions with answers that are far from straightforward and highly nuanced for several reasons. We are dealing with human beings with different needs and circumstances. This health and economic crisis has also had an uneven impact on individuals, and it is unclear how lasting the effects for some will be. And society's attitudes towards financial goals are changing and are much more likely to respond to broader influences than before, due in large part to the impact of social media. Client servicing will therefore involve a much deeper connection with clients that go beyond making product recommendations and just executing transactions. And third, financial advisors and planners must continue to tap into new ways in which you can support your clients. Within the insurance industry, financial advisors are well placed to identify specific gaps in the current offerings of insurance and Takaful products from a consumer's perspective. Your feedback and advocacy to providers on developing less complex, more equitable, and customized products to better meet the needs of consumers can help bridge the inequality gap that has deteriorated further due to the impact of COVID-19. The industry associations also need to take a more active role to reinforce the foundations of trust in the industry. Trust is fostered when the industry, on its own accord, is seen to be consistently advocating the highest standards of professional and ethical conduct. In any profession, misconduct by one or more of the membership is a risk that cannot be completely eliminated. A visible public commitment to strong professional and ethical standards can go a long way to restore confidence when such episodes occur. Such standards must also be transparent to the public to inspire confidence. As trusted advisors, the industry can also do much more collectively to advance financial education. This crisis has revealed a clear need to double down on efforts to raise the level of knowledge and understanding on financial matters. It is imperative that we empower individuals to protect themselves from financial fraud and scams and to make better financial choices in order to build a more resilient and meaningful future for themselves and their loved ones. On our part, the bank remains committed to the development of the financial advisory industry. We will continue to devote significant attention to ensuring a regulatory regime that is fit for purpose and proportionate to the increasing breadth and depth of financial advice expected to meaningfully support financial consumers. The principles that we have outlined in our policy document on the fair treatment of financial consumers will continue to anchor our regulatory focus. Among them, the responsibility to take reasonable care to ensure the suitability of advice and recommendations provided to financial consumers is a paramount one for financial advisors. We expect financial advisors to demonstrate conduct that is not only consistent with the standards set out in the policy document, but in some specific respects exceed those standards to take into account some of what I've touched on today. For example, the standards address instances where consumers may choose not to provide all information requested to enable suitable advice to be given. In such, the financial service provider must caution the consumer that this could affect the suitability of the product recommendation. But the financial service provider could still recommend a product with the appropriate caution. It is not clear to me that this is an adequate standard for financial advisors who may be held to higher standards. In the same vein, there is also a need to consider the potential sensitivity of information that is in the possession of financial advisors and corresponding standards on protection of consumer data that should apply. In addition, the bank will also seek to examine the effects of digital-based advice on consumer outcomes to ensure that the use of digital channels does not substantially lower the quality of advice rendered. So over the coming year, we intend to engage further with the industry on whether there is scope for us to be clearer on aspects of conduct that are more relevant to the status and responsibilities of financial advisors as non-affiliated advisors. Some of you have also raised concerns on developments that may be creating an unlevel regulatory field. This follows the emergence of new players and business models, as well as non-traditional tie-ups in the distribution of insurance and takaful products through online channels. Insurance aggregators, e-payment providers, and insurance brokers, in particular, have been more active in the distribution of insurance and takaful products that cater to individual financial needs in ways that blur the lines between rules that currently apply to financial advisors and tied agents. While we are committed to enabling innovation, we will also ensure that similar risks are regulated in a similar way. To help us achieve both these objectives, we will continue to leverage on the financial regulatory sandbox to provide a safe environment for us to observe innovations and develop sensible regulations that put the consumer's interests first. Given the maturity of the financial advisory and financial planning industry, it is also timely to consider further opportunities to reduce regulatory costs and overlaps. The Bank and the Securities Commission Malaysia are committed to work on the review and rationalization of the regulatory regime for financial advisors and financial planners. The aim will be to elevate current cooperation arrangements between the bank and the SC to a more formal integrated regulatory framework, with a view to further increase efficiency and reduce compliance costs. Importantly, we believe this will better serve the interests of consumers. Ladies and gentlemen, to conclude, this industry can have a significant impact on the well-being of Malaysians. Keeping a focus on professionalism and ethics is certainly the right foundation to build on. These notions are timeless, but they are not static. It is for each firm, each individual financial advisor and planner, and the industry collectively to continuously reflect on how to fulfill your responsibilities to those who place their trust in you in a constantly changing world, and demonstrate through your actions that that trust is indeed well placed. Thank you very much for sharing your time with me today. I wish you insightful and productive discussions ahead.
Thank you, Madam Jessica Chu, for that brilliant speech.